The fair value gap is easily one of the most remarkable tools in trading. Leveraging this exact concept has allowed me to spot countless high-probability opportunities throughout my career. But the reality is that many traders handle it completely incorrectly, causing them to take unnecessary losses. The most confusing part about trading the fair value gap is figuring out which zones on your screen are actually worth your capital, because not all gaps are created equal. Some carry a drastically higher win rate than others. Exploring the secret filters that instantly highlight top-tier gaps, alongside 3 institutional entry techniques, completely transforms how you read price action. To set the stage, let's picture what a fair value gap looks like on your TradingView chart. A fair value gap forms when price expands violently in one direction, leaving behind a wide gap on the candlesticks. Naturally, the market acts like a rubber band, pulling price back toward that gap like a magnet as it attempts to retest and balance the order book, allowing traders to look for entries right as price bounces out of the zone. To plot a fair value gap, you search for a sequence of 3 consecutive candles, focusing on a large middle candle flanked by 2 smaller ones, where the high of the first candle and the low of the third candle do not overlap. That open pocket between the first candle's high and the third candle's low is your fair value gap, which you can highlight using TradingView's rectangle tool. The exact same mechanics apply to bearish setups, and remember, if the wicks of the first and third candles overlap, there is no fair value gap, no matter how massive that middle candle looks. Now that you can spot and draw a fair value gap on TradingView, let's walk through the 5 core filters that separate high probability setups from low quality noise, starting with the rule that a gap must remain unmitigated. Whenever you spot a fair value gap on your screen, you need to ensure price has not touched it yet, because the effectiveness of a gap drains away the moment price retests it for the first time. If you spot a fresh gap that has already been tapped by a previous wick, it is no longer an ideal level. Furthermore, when price does return for that initial retest, it shouldn't retrace so deeply that a candle body closes completely beyond the gap. A full close through the boundary officially invalidates the setup. The ideal entry happens on that very first, clean touch, where price respects the boundary without breaking through. The second filter is straightforward. Whenever you spot multiple fair value gaps within the same market push on TradingView, always prioritize the larger ones. A wide, expansive fair value gap almost always holds far better than a tiny one, because it represents a much heavier imbalance between buyers and sellers, meaning institutions entered with significant volume, creating a stronger zone of support or resistance. Moving to the third filter, if you encounter a move containing multiple fair value gaps that are roughly the same size, you filter them based on their physical position within the move. Gaps located in the deep, lower section of a bullish move carry a much higher probability of holding. To measure this accurately on TradingView, grab the GAN box tool, open its settings, and set the price levels to 0, 0.5, and 1. Click and drag the tool from the swing low to the swing high of the move containing the gaps. The 0.5 line in the middle divides the move into 2 halves. You ignore all gaps sitting in the upper half and focus strictly on the gaps resting in the lower discount region. For short setups, drag the tool from the swing high down to the swing low, focusing exclusively on the gaps located in the upper premium region. The fourth scenario you should strictly avoid is taking a trade when a fair value gap forms directly underneath a major key level. Imagine spotting a fresh bullish fair value gap, but as you look just above it, you see a massive historical resistance ceiling. It is far wiser to skip this setup because major key levels frequently cause price to reject violently, steamrolling right back through your gap. This behavior is rooted in inducement and liquidity sweeps. Institutions know that retail traders place their stop losses directly behind obvious resistance lines. Smart money will purposely drive price through that major resistance level to trap breakout buyers and trigger stop losses, generating the liquidity they need before slamming price back down, which completely destroys any bullish fair value gap sitting directly below that resistance. The fifth filter reveals that fair value gaps forming immediately after a break of structure are pure gold, holding some of the highest win rates across the market. A break of structure simply occurs when price forcefully punches beyond a previously established high or low. Picture price pushing upward, dipping into a minor pullback, and then surging forward again. That peak formed right before the pullback is the previous high. When price surges above that line to print fresh highs, a break of structure is confirmed. When a fair value gap forms during or immediately following that structural breakout, it signals immense institutional momentum, making it highly likely that price will trace back into the gap and bounce aggressively. When it comes to executing trades on these valid gaps, one of the most effective entry techniques is targeting the exact midline of the gap, known as the 50% equilibrium level. Grab your measurement tool on TradingView, anchor it from the bottom line of the gap box to the top line, and mark that midpoint. You set your limit entry directly on that midline, placing your stop loss safely just beyond the invalidation boundary of the gap. As price drifts back into the box, it hits the midpoint, triggers your entry, and launches into the intended move. Beyond basic entries, combining fair value gaps with advanced market concepts unlocks consistency, starting with the inversion gap strategy. An inversion gap is simply a fair value gap that failed and was completely broken through by price. Just because a gap gets broken doesn't mean its usefulness is gone. It transforms into a flipped level for a single, high probability retest. Imagine watching a bullish fair value gap get violently smashed downward by heavy selling pressure. You now wait for price to drift back up toward that broken gap from below. That failed bullish gap now acts as a firm resistance ceiling. You take a short position right as price touches the broken zone, setting your stop loss just above the box and targeting a profit distance at least twice your risk, capitalizing on the market as price rejects the level. The second strategy blends fair value gaps with the Fibonacci retracement tool on TradingView to create high probability confluence. Apply your Fibonacci tool from the swing low to the swing high of a major move containing multiple gaps, paying close attention to the 61.8% golden ratio level. You scan the setup and target the fair value gap that aligns directly with that 61.8% retracement level. When price falls back into that specific gap, you wait for a confirmation candle to close inside or above the box. Enter your long position, place your stop loss safely below the gap, and target a 2:1 reward to risk ratio as price bounces out of the golden zone. The third strategy pairs higher time frame fair value gaps with lower time frame momentum confirmation. Start on a higher time frame, like the 4-hour chart, and overlay the 200-period exponential moving average, EMA, on TradingView to establish the master trend. If price is trading below the 200 EMA, you strictly search for bearish fair value gaps. Once you spot an unmitigated 4-hour bearish gap, you wait for price to retrace into the box. Instead of entering blindly on the 4-hour chart, drop down to a smaller time frame, like the 1-hour chart, and monitor a momentum indicator like the MACD. The moment the MACD lines complete a downward cross inside the zone, you enter your short position, placing your stop loss above the 4-hour gap's invalidation point and targeting a clean 2-to-1 reward to risk payout as the higher time frame trend resumes.